Thursday, 11 of April, year of our Lord 2023, and we're about to get started with another lesson in personal finance. Today we're going to talk about asset allocation and tax allocation, and I'm going to show you and anyone who joins us today how that works in your financial plan. So let me jump over to the Zoom room and get things started. There are some folks in the Zoom room. I'm going to admit them now. Welcome to the Zoom room. We're getting started in personal finance. I'm waiting for you guys to join. I just clicked the button to admit everyone who was in the waiting room, and that looks like it's taking a minute. I've been having trouble with my internet using Comcast here in my studio, and yesterday I lost internet a couple of times, so I'm hoping. It looks like it's slow. The blue button is on my internet indicator, which means I should have good internet. Can you guys, somebody chat in and tell me if you can hear me? And also, don't forget to chat and just say you're here, as usual. Thank you, Vivian. I appreciate that. Hey, welcome aboard, Christian and Vivian and everyone else. Okay, let's get started. I'm assuming you can see my screen. Is that true, Christian? I'm moving it up and down. Tell me if you see this picture. Can see your screen. Christian, are you seeing me move this in and out? You're seeing that? That's a big screen for you? Yep, cool. Okay, good. For some reason on my Zoom, it's showing me a little teeny thumbnail of this on the right side, which is fine. I'm going to jump on over to another program and we'll get started. Okay. Well, I hope you guys had a great Easter celebration, some time off. If you haven't noticed, I'll just tell you that I haven't graded any papers from last week, so your articles are sitting in my queue waiting to be graded. In fact, I was going to spend a few minutes today and what I really want to do is I wanted to open a couple of these and just go through the assignment with you. But I'm a little afraid to do that because the names are on these, so I'm going to just try to there's no personal information in any of these. It's just your homework assignment. But I'm going to try to be very careful not to show you any names or any personal information, which, again, there is no personal information. This financial planning platform, I mean, it would have a birthday, but you all changed your birthdays to be different. So that was part of your homework assignment. So anyway, that's what I'm going to do partly. That's one of the things I'm going to do today. I'm going to also try to keep an eye on the chat. So before we get started, we got a couple of minutes. If you could, if you have a question, go ahead and post that now, and I'll try to answer it before I get started. We have a lot to cover today. I mean, just like every time we get together, there's a lot to cover because personal finance involves a lot of details. So I'm going to try, what I want to do though in this lecture, in this lesson, is try to help give you some confidence, a little clarity as well about your upcoming assignments, because we're getting closer and closer to the capstone assignment. And so one of the things that Christian, tell me where you're seeing that. So you said assignment 11 mentions wanting an outline of the Zoom meeting, but doesn't give any specifics. Do you want an outline or can we skip it? So yes, you can skip it, but more importantly, Christian, I went ahead and updated that. Let me see. Should be here. I deleted that from the assignment this morning, so that's the wrong assignment. Now I'm looking at the money study group, and this should be pretty close to what's in Blackboard, although in Blackboard, just FYI, there are a couple of videos here to help you understand today's topic better. So those Okay, it is still in Blackboard. Hey, do this for me, Christian. Can you clear your cache and refresh your page just to be sure? Because I'm pretty sure you're looking at an old version of the assignment. I just updated it, and I may have missed it. If I did, I'll fix it. But the answer to your question is you don't have to do that review, that outline. So that was last semester. I had that in there for the students who were I wasn't sure they were watching the Zoom meeting, so instead of being in doubt and questioning, I just asked them to do an outline. You guys seem to be doing a great job this semester, this cohort, in just doing your homework assignments and doing a great job. So to answer your question, Christian, you do not have to do that. So here's Maritza's question. For assignment 11, for the tax allocation section, do we put a total of $150,000 across 3 different accounts, or do we put $150,000 in each in 3 different accounts? That's a great question, Maritza. I'm so glad you asked that question. This is a total of $150,000. So what I want to do is I want you to add this money to your financial plan so that you can begin to see the impact on your financial plan for having good tax allocation. So we've been working on asset allocation for some time. That was last week's assignment. This week I'm going to teach you about different types of accounts. So the answer to your question, Maritza, is it's $150,000 total. And remember, and this is a really good question, remember the whole purpose here is for you to, now that you've done a little research and you've figured out what your dream job is going to be, and how much you're going to be making if you get the dream job that you're hoping for. Remember, the purpose of this assignment and last week's assignment is for you to take those assumptions based on your income, based on what you're studying and what field you're going into. And I know these are all assumptions, but the objective of this lesson was for you to give yourself 10 years, make yourself 10 years older, and then pretend that you started out using these strategies in your financial plan. So in order for you to do that, you have to actually go into your financial plan and put some money into those accounts. So that's what you were supposed to do. And most of you did a great job with that. I was looking at a couple of assignments this morning where one student actually, Maritza, put all of the money into one account. And it turns out she put it into, or he, I'm not sure who, put it into I'm going to show you that one just real quick, just so you know I'm telling you the truth. And it's such a good question. Ooh, sorry about that. How do I get out of here? Oh, there we go. So in this, I believe it was this one. Let me just show you real quick. When I grade these, this is what I do. I'm looking for the components of your plan to see if you have any, if you're missing anything. So here I believe, I thought that was the one. You know what? I am looking at the wrong assignment. So give me just a second. I'm just going to show you to answer your question. I think I'm having trouble with my internet. Anyway, this next assignment that isn't loading, this student actually put all of the money into one account. I'm not going to show you that because it's not working so well. I'm going to go back here. So, oops. Gosh, I'm having all kinds of trouble today. So anyway, Maritza, that's a great question. And the answer is you want to put $50,000 into a taxable account, $50,000 into a tax deductible account, and $50,000 into a tax-free account. And you're going to learn today about types of accounts. That's what this lesson is about. So you're going to find that not only do you have your 401k, that's one type of account, and it's one specific account that you needed and should have added to your financial plan. But in addition to that, you're going to add an IRA account, a Roth IRA account, and a taxable account. So those 3 types of accounts in this week's assignment are designed to illustrate the different ways that those types of accounts work. And inside of your financial plan, and we will also use asset allocation in each of those 3 accounts. So you're going to have 4 accounts. You'll have a 401k account, and that's going to be funded with the amount of money that you decided or determined from your research was appropriate for the company that you got the job, your dream job at. So the 401k is one account, and you're going to need to fund that and tell your financial plan that I'm funding my 401k and I'm getting this match. So you saw the data cards for that account. And then the second, third, and fourth is what you're adding this week, which is tax deductible IRA, a tax-free Roth IRA, and a taxable account. And we're going to talk about the types of accounts today. And I'm going to use my buckets. I'm going to use some buckets to show you, to illustrate these types of accounts. So I have props today, and I have some buckets. In fact, if we go up here, I think I have buckets somewhere. Buckets, yeah. I'll use the pictures. Man, I think I have trouble with my internet today. Every time I click on something, it just goes really slow. Hey, I want to ask you a question before we get started, and we're going to get started here in just a minute. Have you guys seen in Blackboard or Money Study Group or in any post that you've seen, you know those little images that it looks like something's supposed to be there but nothing is there? Like where I put an image into a post, whether it's in Money Study Group, Blackboard, or anywhere else, sometimes that image loses its link. If you ever see that, let me know. I can fix that. My team told me, like this morning, this post, all of the images for the buckets were just gone. And so we fixed that. And I'm finding, by the way, that in Blackboard, that happens a lot. The images, everything that I post, when we post in Blackboard is just, it's Blackboard. What can I say? Fortunately, if you didn't know this, starting next semester, the University of Houston and the Bauer College of Business is transitioning to Canvas. So it's similar to Blackboard, but it has so much more functionality, and it's going to be so much better for those of us who teach asynchronous courses. It'll make it so much easier for me to put good content into your assignment area as opposed to what we currently have with Blackboard. We'll still have Money Study Group, but honestly, Money Study Group, the online course, was designed partly because Blackboard just had so many limitations. So we're moving forward in the world of technology, and we'll be doing that. Okay, so I'm not going to show you. I do want to show you one thing before we move on. I want to show you something that I've had a couple of questions about. And I'm going to try to open one of these. I do not know. It's not opening. I wanted to show you, I had a couple of questions, and we always get these questions about getting a zero, in fact, maybe down here. When we get to your plan, and you do your retirement analysis, a lot of you are getting a 0 probability of success. And so I got a couple of emails that were asking, how do I fix that? And so I just want to mention that right now, that's not a problem. It's not something you need to worry about, but it's a great question to be asking yourself. Why is it that my plan has a 0 probability of success? And so the way we're going to fix that as we move forward, that will be a problem in your capstone assignment. You will receive a 50-point deduction if one of two things happens. So in your capstone assignment and in this week's assignment coming up, I'm going to start looking at the probability of success in your plan. If you have a 0 probability of success, that means that your expenses are too high or you're not putting enough money into your plan to be able to fund the goals that you have. And so, my role, my hope, my goal, my mission in helping you create a financial plan that gives you a good idea of how money works and how your financial choices impact your financial future. I mean, we're using a mathematical financial planning program. That's what Bauer and Right Capital do for you. But, if you don't put in the right inputs, you're going to get terrible outputs. So most of you are going to find that your financial plan is producing a really good amount of money at the end of the plan. And you can see that this plan doesn't show it, doesn't show any, it doesn't show the amount that you have at the end of your plan, but you will see that in your plan. And so don't worry if you have a 0 probability of success. Moving forward, I'm going to teach you what to look for to fix that, okay? And so right now we're just adding data to your plan, and your plan is probably not working great. Some of your plans are working awesome, but many of you are not finding a good, in the retirement analysis, you're not seeing good results. So we'll go over that. But today we're going to talk about tax allocation. So we talked about asset allocation last week, and you guys did a good job from what I've seen of your learning about asset classes and how investing works using different strategies that really deal with asset classes. And so hopefully that's been helpful for you. As I told you last week, when you start to learn investment strategies, you got to be careful to not put too much pressure on yourself to try to become an expert overnight, because that will kind of derail your mission of learning how to invest. But I promise you, if you stay with those 4 strategies that I taught you, you will, and you can go back and watch that video again and just, save those posts, save that information. You're going to need it moving forward, especially when you start funding your 401k. So these are some videos from someone else. I think you're going to want to take a peek at them. They're posted in Money Study Group for you. These videos will give you just a different perspective than I'm going to give you today about types of accounts, specifically IRA, Roth IRA versus a 401k. There's a lot of information to learn, and you're going to learn some of it this week just by doing your reading and taking your quiz and doing your assignment. But again, I don't want you to feel like I expect you to be an expert in these types of accounts. I am an expert. I'm a certified financial planner, professional. I do financial planning, and I sometimes regularly don't feel like an expert in these types of accounts. There's so many rules, boundaries, and limitations in each different type of account that you really have to just have a good tool for researching and finding the answers to your questions in any specific situation. But for you, it's going to be pretty simple. I'm going to teach you the basic ideas that help us achieve the second law of personal finance, which is the law of tax advantaged investing, and it's all about types of accounts. So I'm going to talk about buckets, and I'm going to just give you my take on how I view types of accounts. I view them as different types of buckets that hold stuff. So you can watch these other videos, and Jim Cramer, I can't remember who the other gentleman is who does it, but he's young and way better looking than I am, and you'll probably enjoy his video more. And so I encourage you to watch them and do a little research. But we're going to talk about types of accounts, but I wanted to, just show you in your assignment. You'll see all these screenshots, and it should help you just basically know what you're going to do. And you're going to give me screenshots again, as always, just to show me that you actually updated your financial plan. So let's get started, and I just want to go over the buckets. I think I'll go to my buckets so that I can have the bucket on the screen as I'm showing you my bucket. So this is the big blue bucket, and you can see I have it in my hand here. The big blue bucket represents taxable accounts. So if you have, let's say you have $1 million, or $100,000 or $10,000, or maybe you have $1 billion. You could actually have $100 billion, and it could fit into this big plastic taxable bucket. In other words, there is no limit on how much you can have in this particular bucket. This bucket has no tax advantage, okay? That's why it's plastic. That's why it's big. That's why it's just a plastic bucket. And so that's the first type of bucket you need to understand, is if you invest, like I do a lot of investing on my own, in my own account, and I have a pretty good sized bucket. It's not even $1 million, but for me, it's a pretty big bucket. And that bucket is taxable. So I can do a lot of things in that account. I can have margin, which I do, which means I can borrow money from my broker to invest in Tesla stock or even to short Tesla stock. I can do all kinds of things in my taxable account in terms of investment strategies that I can't do in other types of accounts, because there are certain benefits to having a taxable account. Like I can trade options, I can leverage my account, and that's all part of being a taxable account, because when I make money, when I make profits investing, I get taxed on every transaction in that account because it's a taxable account. And that's why it's a blue bucket. It doesn't have any protection like the other types of accounts we're going to talk about. It's just a big blue plastic unlimited bucket, and we call it a taxable account. And you need to understand that distinction for that bucket, the taxable bucket, basically means there are no tax advantages. That's why it's taxable. There are no tax advantages. So remember, I was born on April 15th. That's tax day, which is coming up. And my first son was born on, my first child, which was my son, was born on December 31st. And so he was a tax deduction for the entire year. So that's a taxable account has no tax deductions. You put money in it, you don't get a tax deduction. Unlike, what did we talk about last week? Your 401k, the perfect investment, your 401k. When you put money in your 401k, if it's going to be matched by your employer, then that account is a tax deductible contribution into that account. And so not only do you get the match from the company, but you get a tax deduction for your contribution. So that's not true in this blue bucket. It's a taxable bucket. And we will talk a little bit about that little pink shovel soon before we end today. So the next bucket is this bucket. And it's big, but it's not unlimited, and it's metal. And that means it's got some extra protection, some extra benefits. And I use this bucket to illustrate, let's see, can you see that bucket? Yeah, I use that bucket to illustrate a 401k, because a 401k, like I told you last week, the perfect investment. It's one of the best ways for investors to save for retirement, because this big black bucket has lots of ways that it's protected. You're going to learn a little bit about that as you go forward and learn about types of accounts this week. But it's also it's tax advantaged, which means it's tax deductible, which means when you put money in it, you get the deduction, a tax deduction. But unlike this taxable account, you don't get to take your money out of this account anytime you want. These tax-advantaged accounts, including your 401k, have rules and boundaries and limitations that prevent you from putting your money into those accounts and then turning around and taking the money out because you want to buy a new car. These types of accounts give you lots of benefits and advantages, tax advantages, but they're designed to help you save for retirement, for long term. And that's true for this big brown bucket, which is your 401k. Now, it could be a 457 if you work for the government. It could be a tax sheltered annuity if you work for it's the number. Remember, these numbers in all of these, like the 401k, is the paragraph number in the tax code. That's all that number really means. But that's where you would go to learn anything you want to learn about the rules, the boundaries, and the limitations related to that specific type of account. And so the 401k is a paragraph number for that type of account. And so if I say 403b, that's a different type of account with a different paragraph number. But the truth is, it's very similar to the 401k, because the 401k is for a for-profit company. It's a retirement plan, and typically the employer provides some kind of incentive for employees to contribute to that type of account, and the employer generally offers some type of match to incentivize employees to invest in their retirement using their 401k account, so that, here's what's in it for the employer. The employer wants you to be a long-term employee. And they know that if they give you the benefit of a retirement plan and a great 401k plan, you're going to be more likely to stay with that employer. So that's the incentive. That's what's in it for me as an employer, to give away money to you as an employee. And your job, to be smart, is to take advantage of those benefits and make that part of your research and deciding who you're going to work for, who has a great retirement program. If you're a for-profit company, it's the 401k. But if you work for a school or a church or a nonprofit, then you're going to be using a 403b. It's just the same thing, just a little bit different flavor. And they don't usually have a match, because nonprofits, schools, churches, they're not for profit, and they just give you a way to save for retirement in a tax deductible way. So your brown bucket, if you're a teacher, won't be a 401k, it'd be a 403b. If you work for the government, I think it's a 457. Again, the number of the paragraph in the IRS code, all the rules, all the boundaries, and all the limitations. But the brown bucket represents the tax deferred investment, not the 401k, which is tax deferred. It's identical in that regard, but the difference is the 401k account, that's not the brown bucket. Well, actually it is the brown bucket. That's the 401k, but the tax deferred bucket, which is very similar to this, would be an IRA. So let's talk about the difference between this tax deferred account, this big bucket, the brown bucket, which is your 401k, your 403b, and this tax deferred bucket, which is same as this in terms of when you put money in, you get a deduction. Okay, these two are the same, but this tax deferred bucket is an IRA. And does anybody know what IRA stands for? Can you guys give me what that stands for? IRA. I'm going to wait for a minute, because I just want to make sure, if you're watching on YouTube or Facebook, if you haven't left a comment yet, it's time to leave a comment and tell me, what do you think IRA stands for? Yes, you can Google it. You can use Vivian, that's what I always thought. Individual retirement account. Yep, that's what I always thought. But that's technically not what it is. But it's like everybody thinks that and believes that. So since everybody thinks that and believes that, it's true. An IRA is an individual retirement account, but that's technically, just FYI, a little trivia for you. IRA stands for Individual Retirement Arrangement. So that's what it actually stands for. But it is, in essence, an individual retirement account. So let me change my buckets on my page here. So far we've talked about 3 buckets. We've talked about that big blue bucket, which is taxable. We talked about the big brown bucket, which is your 401k, your company retirement account. It's a type of account. It has different rules. It's the one that allows you to put the most money into in a tax-deferred way. But you can't take the money out until you get old like me, over 59 and a half, and then you can take the money out without paying a fee, a penalty, and taxes, because remember, you're getting a tax deduction when you put the money into these accounts. When you put the money into these two accounts, you're getting a tax deduction. If it's your 401k or your IRA, your tax deductible IRA, you're getting a tax deduction. So what happens when you take the money out of a tax deferred account? What do you think happens? If you take money out of that account, you pay taxes. And if you take money out of that account before you're old like me, 59 and a half, I'm turning 62 this week, I think. Maybe, yeah. I was born in 1962. Does that, am I turning 61? I think, yeah, math. Getting old. Tax deferred account. When you put money in, you get a tax deduction, just like the brown one. Just a different amount. You can only put, you're going to learn this week too. You're going to do a little homework, and you're going to figure out how much money can you put into a tax deductible IRA this year. Okay, so back to the tax deductible IRA. It's a pretty good sized bucket. It's a metal bucket, and that's what it represents, is the tax deductible IRA. So we did the blue bucket. Come on, I got too many buckets here. Brown bucket, I'm looking for, I guess we're not going to see. Okay, we're going to jump into the gold bucket now, but I thought I had a picture. Sorry about that. My pictures get all discombobulated. So those are the three buckets we've talked about so far. Can you name them? You are going to have all three of those buckets represented in your financial plan, because you're going to have, after this week, you're going to set up a taxable account. That's the big blue bucket. You should have already set up your 401k account with the amount of the match that your employer is going to contribute and how much you are going to contribute. So yeah, that one should have already been there. But then in addition to that, this week you're going to add this tax deferred account. It's called a tax deductible IRA. And then here's another thing we're going to do. I think I'm just going to mention this. This gold bucket represents a tax-free Roth IRA. So that's what the gold bucket is. It's different than the tax deductible IRA. Do you know the difference between a tax-free Roth IRA and a tax deductible IRA? We'll get to that in a minute. But first, let's talk about what happens when you put money into this bucket. This is your 401k, and you're working for the company that you're working for right now when you graduate. But then let's say 5, 6, 7, 10 years down the road, you decide to switch to a different company, or maybe you start your own company. At that point, what will you do with the money in your 401k? What will you do with the money that you contributed when you worked for that old employer? Typically, what you do is you roll that money over into an IRA account. And that's why this bucket can get really big, because every time you leave or terminate from an employer, generally you take that money and you put it into your own IRA. And it's a tax deductible account, just like it was when it was a 401k. But now it's yours to manage. It's not being managed by the company anymore. When you roll it over into an IRA, it's yours to manage. Now, you may work with a financial advisor, or you may manage it yourself. You get to decide that, but it's your account. It's no longer attached to the company. And every time you leave one company and go to another company, typically you're going to roll over the funds, the money that you contributed to that 401k or 403b or 457, whatever type of organization you worked for. When you terminate, you roll the money over into your own account, an IRA account. And it doesn't matter if you worked for a nonprofit or if you worked for a company like Shell. When you leave that company, the funds that you put into that account get rolled over to your IRA, okay? So that's something you should, that's a question you typically I get. Nobody seems to be asking questions today. Let's see if I got any chats. Let's see. Uh-oh, I got somebody in the waiting room. Kind of late to be joining in the waiting room, but anyway, let me jump over to the chat and see if I can find the chat. Where's the chat? Show chat. Okay, sorry. I'm not seeing my chat, so if you're chatting a question at the moment, I've lost my chat. Oh, there we go. Got the chat. Nobody's chatting, though. Orlando, you were the last one to chat at 10:29. So hopefully on Facebook and YouTube, we're getting hammered with comments, questions, and I'll answer those questions later. If you're on YouTube or Facebook, welcome. If you just joined us, someone just joined us, you're kind of late, but the prompt was there in front of my face, so I let you. I think it was Raj. Anyway, welcome. Chime in. Put in when you got here. Do that now. And feel free to ask a question. Okay, so let's go back to the picture of the buckets. And I want to now transition from the tax deductible accounts to something very special, a tax-free Roth IRA account. So let's do that now. I'm going to find a picture, if I can, of my favorite little bucket. And there we go. That is the, so they're kind of blurred, but you see 4 buckets there. The big plastic bucket represents, go ahead and make a list here. I want you to make a list and then chat it in. There are 4 buckets there. The gold bucket is the Roth IRA, a tax-free Roth IRA. That's what the gold bucket stands for or represents. So we've got the blue bucket, the big blue ugly bucket, the big brown bucket, and then the not as big beach bucket looking thing, and then the gold Roth IRA. So what are those buckets? Go ahead and you need to know what these buckets represent, because you're going to have one of these types of accounts, each one of these types of accounts in your plan this week. And it is your homework assignment to give me some rules, boundaries, and limitations that relate to each of these types of accounts, because I want to make sure after this lesson that you understand the difference, the main distinctions between each of these 4 types of accounts. So these are 4 types of accounts that you need to be familiar with. And for this week's assignment and this week's quiz, you will need to do a little reading, do a little research, and those videos should help. But tell me right now just the names of these 4 types of accounts. Let's go ahead and see if you can name them in the chat into the chat, post now, chat it. Those 4 buckets, what are they? What's the big blue bucket? Okay, go ahead. I'm looking at the chat box now. I found it. Nobody's chatting. Orlando, are you still with us? Maritza, Christian, you guys still there? Blue, Orlando, that says blue that don't make money. No, come on, man. Do you think I have a big blue account that doesn't make money? It does make money. That's not the point. So try again. That's not it. What does the blue bucket stand for? That was not it. Blue doesn't mean that it doesn't make money, Orlando. That was a good try. I appreciate it. I really do appreciate it. But try again. Taxables. That's it. Sadaf says it's a taxable bucket, which means if it makes money, which hopefully it does if you're investing in it, then you pay tax on every transaction. That's why it's a big blue taxable bucket. So that's right. That's the big plastic blue. Maritza says it's a taxable account. Do you know what that means, Maritza? It's a taxable account. Do you guys know what that means? If it's a taxable account? I mean, remember, we're talking about the difference between a tax-advantaged account versus a taxable account. And if you don't understand that distinction, then it's not going to do you any good to even think about updating your financial plan with good tax allocation. Tax allocation is kind of important, probably not as important as asset allocation. Well, actually it is very important, tax allocation and asset allocation. But today we're talking about types of accounts so that you can use this strategy of tax allocation in your financial plan. Christian says, if you withdraw from the taxable account, you pay income taxes. No. Actually, Christian, that's not true, but it's a great question because it helps me understand that I'm doing a terrible job of helping you guys really understand the distinction between a taxable account and a tax-advantaged account. Because when you put money into your taxable account, you don't get a tax deduction. So when you take the money out of your big blue taxable account, you don't have to pay taxes on it because you didn't get a tax deduction. On the other hand, if you put money into your 401k and you get a tax deduction, and you put money in your tax deductible IRA in this bucket, and then you take it out, then you have to pay taxes because you got a tax deduction. Do you see the difference? A taxable account versus a tax-advantaged account? So that was a great question, Christian. But if you took money out of this account, your tax deductible IRA, if you put money in this account and then you took money out, then you have to pay taxes. And you have to pay a 10% penalty for the money you withdraw from this account because you're not 59 and a half. You have to be age 59 and a half to take money out of this account without paying a penalty. But you still pay the taxes when you take it out of this account because you got a tax deduction when you put the money into this account. Same with this big brown bucket, which is your 401k. When you put the money in it, into this account, you got a tax deduction. So when you take the money out, even if you're old like me, you still have to pay the taxes, income taxes, because you got an income tax deduction when you put the money into the account. So again, remember, if you're under 59 and a half, age 59 and a half, in addition to paying the income taxes when you take the money out, in addition to paying the income taxes, if you're under age 59 and a half, you pay an additional 10% penalty. So you don't want to be taking money out of these accounts. If they're tax-advantaged accounts, they're for retirement. Okay, so let's try again. I'm going to ask you again. Tell me what the big blue bucket is and what makes it a taxable account. What does it mean to be a taxable account? Give me your comment. If you're watching on Facebook or YouTube, leave a comment. Just let me know that you understand when I say it's a taxable account. What does that mean to you as a taxpayer? What does that mean? Put it in your own words. Just what does it mean? You need to understand what is a taxable account. How does that work? What does that mean? How does it impact your taxes, your tax return, your overall financial plan or your financial strategy? It's part of your tax allocation, which is what I'm trying to teach you today by helping you understand different types of accounts so that when you use the strategy called tax allocation, you know which type of account you want to put your money in to build wealth. So the big blue bucket, somebody give me a comment. I'm looking at the chat box. You guys just aren't very chatty today. Chat with me. Chat with me. Or I'm just going to go to ChatGPT and I'll chat with ChatGPT. And I'm sure ChatGPT, you're probably doing that now instead of listening to me, because nobody seems to be chatting with me today. I'm just sitting here chatting with myself. So help me understand, help me know that you understand what is this bucket, this big brown bucket, which stands for a 401k. Do you know what it is? You guys are just going to refuse, or maybe my computer's broken, but I'm not seeing. Thank you, Christian. With a taxable account, your money's already been taxed. So when you withdraw it, you're not being taxed. That's exactly right. So now you know the difference between that and the money that you put into your 401k. You get a tax deduction in this one. And that's also true with a tax deductible IRA. So whether it's a 401k or a tax deductible, any account that's called tax deductible, it means that when you put the money into that account, the IRS gave you a tax deduction. So then when you take the money out, you have to pay taxes. And if you're young, you pay a 10% penalty. Thank you very much, Christian. I appreciate you participating because no one else seems to want to participate today. And of course, that makes me sad. It makes me feel lonely. It makes me feel like I need to, I don't know what I need to do, but thank you. Vivian, that's a frown. Don't frown. That makes me sad. I'm not sad. I'm just kind of trying to get you guys to, chat. You have anything to say, Vivian, besides a sad face? Did I make you sad? I didn't mean to make you sad. Sorry. Okay, let's get back to the class, the course, the lecture. So this little gold bucket, I don't remember why I have this. Oh, I know why I have this in here. I generally talk about, so this is a Roth IRA. It's tax-free type of account. You're going to learn about it this week. You're going to do a little research, and you're going to tell me, what can you put into a Roth IRA? How much money can you contribute? It's my favorite type of account, especially for young people like you. I started investing in my Roth IRA when it first came out in 1998. I think that year we were allowed to put, I want to say $5,000 into it. This year it's $7,000. If you're 50 or older, I'm over 50, so I can put $7,000 into this account. And basically, I don't get a tax deduction, so it's different than a tax deductible IRA. So with a Roth IRA, I don't get a tax deduction. But the cool thing about this account is that when the money grows, I don't have to pay taxes on it. So this is like the ultimate type of account. You can only put so much into it. The IRS doesn't want you to take advantage of something that's too good to be true. So instead of letting you put unlimited amounts of money, they make it limited to how much you can put in. And you also, if you make $1 million a year, you make too much money to be able to take advantage of this type of account. So you'll have to learn a little bit about those rules, boundaries, and limitations this week. But inside of this bucket, I have this gold gift package, which is just really to illustrate. And I'm not going to today, but I used to talk about if you had a Roth IRA, like I had a Roth IRA in 2009. In 2009, Apple stock was trading for $125 a share. And I had $100,000 in my Roth IRA. And so I used to tell the story. It takes a while. That's why I'm not going to do it today, because I don't have that much time. But inside of the Roth IRA, the story that I told was that I invested. If I would have invested all of my $100,000 in Apple stock and $125 a share, I'm gonna go ask. I'm gonna do an article. I'm gonna do an article that's gonna unpack that, because next semester I want to tell that story, but it's gonna take some time to make it super clear. But think about it: if you had $100,000 in a plastic taxable account, and you bought Apple stock, you had $100,000 and you bought Apple stock back in 2009 for $125 a share. Do you have any idea how much money you would have in your plastic bucket today? And if you sold all of your Apple stock today, how much money would you have in that blue bucket? That's the first question. The next question is, how much would you pay in taxes? Because in that plastic bucket, that taxable bucket, now that you sold the stock, you have to pay capital gains. You have to pay taxes. It's not income tax, but it's a tax on the gains that you had when you bought the Apple stock. Remember, in this story, you had $100,000 in your blue bucket. your taxable account in 2009, after the great financial crisis, or in the middle of it, Apple stock was selling for $125 a share. That's true, it was. The question is, if you bought, how many shares could you buy if you had 100,000? It's math. It's simple math. I'm not going to do it today, but I'm going to write an article, and I'm going to tell you that story next week with the article, so you can go and read it while I tell you the story, because otherwise it would just be a bunch of math. But it's amazing math. And that's why in this, so the question is, if you had 100 grand in a blue bucket and you invested that 100 grand in Apple stock in 2009 when it was trading at 125 bucks a share, how much would that Apple stock be worth today? And if you sold all that stock today, how much money would you have in your blue bucket? And then the question for your CPA is, okay, how much was my capital gain on that investment? And now how much tax do I have to pay? And how much do I have left over? I mean, that's what every investor wants to know. And Christian, that's why your question was so important. And so it's so important that you understand the difference between a taxable account and a tax-advantaged account, especially a tax-free account. Because at the end of the day, when I do this article, I hope I get it done this week. But I'm going to commit to you. I'm not going to try, because you know what happens when we try, we don't do it. Now I'm committing to an article that unpacks the math behind this bucket. So tune in next week, and I'll have the article and I'll give you the answer. But this is Apple stock that was purchased in a Roth IRA in 2009, 100 grand's worth. I had 100 grand in my Roth IRA. I wish I would have done this, but I didn't. But I'm going to tell you the answer. If I would have, how much would I have in terms of net worth that's not taxable, because I put it in a Roth IRA versus using this big blue bucket. So I'll get that to you next week. And then when you see that, when you see this article, you won't even have to read the whole article. You can just read the summary, and it'll be like, oh, that's why Professor Munchback is saying that a Roth IRA is a really good idea for a young investor who has a lot of time to invest, because that bucket, the Roth IRA, is a tax-free bucket, which means as you build wealth in that bucket, when you take the money out, you don't have to pay income tax. It's the only bucket like that. So it's a pretty important bucket. So those are the types of accounts, the 4 types of accounts that we talked about right there, starting with the big blue bucket, the big brown bucket, so the big blue bucket is taxable. The big brown bucket is your 401k. The beach bucket there, that's a pretty big metal bucket, that's your tax deductible IRA. That's the one you would roll your money over into an IRA, an individual retirement account, tax deductible IRA. That's what that beach looking bucket is. It's important for you to understand that one, because you will use that in your lifetime, I promise you. And then finally, the 4th bucket, the gold bucket, the best bucket, is the tax-free Roth IRA bucket. So you're going to set up in your financial plan this week those additional 3 types of accounts. You've already got the 401k. You should have already put that into your plan. So now you're going to add a taxable account, and you're going to put 50 grand in there, and then you can go ahead and allocate your assets the way you feel comfortable. Because remember, this is a taxable account, but it's going to include investments. It's not just cash, it's investments. I want you to make use of that blue bucket, invest it. And then I want you to set up another account, which will be a tax deductible IRA, and put 50 grand into that one. We will pretend that over the 10 years, while you were putting money into your 401k, that you changed jobs somewhere along the way, and you rolled over $50,000 into your tax deductible IRA. And then in addition to that, let's assume that you were able to contribute along the way to a Roth IRA, and you've accumulated 50 grand in that account as well. That's your homework assignment. In addition to writing an article just to tell me what are the distinctions between these 4 types of accounts: a taxable account, 401k, tax deductible IRA, and a tax-free Roth IRA. Okay, that's your assignment. That's, if you guys can just get a decent understanding of those things, these 4 types of accounts, then this week's assignment is a home run. I promise it will help you in your investing life to build wealth over time. Now let's talk about, for just a minute, that nice little ugly, goofy, pink shovel. So I lost my shovel. I think I know where it is, but I'm not going to go look for it right now. And I usually would hold it up and wave it in front of the camera. But the pink bucket represents, what do you think it represents? Do you have any idea? What do you think the blue bucket would represent in this lesson, in this illustration about buckets? Because these are buckets, right? And that's a shovel, right? So what do you think I'm going to say about the shovel? What does the shovel represent? If I were going to tell you a story about buckets to illustrate types of accounts for investing, for tax allocation, and there's a bucket involved in this story, what do you think the bucket would stand for? I'm not sure anybody can answer this question. Not sure anybody wants to at this point. But if you can, go ahead. I'm going to tell you what it means, what it illustrates. And you're going to be like, yeah, that's what I was thinking. And I'm going to be like, yeah, but you didn't write it. Moving assets between accounts. Orlando, that's partly right in that, but it's not completely right. So it is about assets, and it is about putting assets into types of accounts. But it's a little different. So I don't know if I ever told you. Did I ever tell you this story about the leather Converse tennis shoes that I desperately wanted when I was like 10 years old? And I lived in a household with 3 siblings at the time. Another sibling came along later. But my dad worked and my mom didn't work, and we didn't know we were poor, but we probably were. We just didn't have we didn't have extra money. We all went to private school, went to a little Christian school. And so my dad worked, my mom didn't, and we were always tight on money, but I really wanted these leather Converse tennis shoes that were endorsed by Dr. J, Julius Erving. He was Dr. Dunk back in the day, and he endorsed these shoes, and everybody had leather Converse tennis shoes, and I really wanted some. The problem was, we bought all of our shoes at Kmart at the time. Kmart was a cheap store like Walmart, and my mom would buy us, the boys in my family, canvas Converse tennis shoes. Now, back in the day, they weren't like an Icon. They were just a basic tennis shoe made by Converse, and they were canvas. They were $4 a pair if you got the low tops. I think they were $5 a pair if you got the high tops. But we were allowed to choose in our family which tennis shoe we wanted. We could either get a white Converse tennis shoe, and we could even choose whether it was high top or low top. Or we could get the black Converse canvas tennis shoe, and we could choose whether it was high top or low top. But those options did not include the leather Converse tennis shoes. So I really desperately wanted a Converse leather pair of Converse tennis shoes, and I wanted the high tops, because all my friends had them and they were cool, and I had the canvas kind because they were cheap. So I asked my mom, what do you think I asked my mom? When you go to the store, will you please get me a pair of black leather Converse high tops? And she said, what do you think she said? Go ahead and chat that in now. If you've listened to the story so far, you know what my mom said, or you could at least guess. Maybe wrong, because if you guess the most common guess, you'd say she said no, which wouldn't be true. She didn't say no. She did say too expensive, Orlando. That's exactly right. But she said, you're going to have to ask your dad. So I did. I'm like, okay, I'll ask Dad. I'm not afraid of Dad. I love Dad. Dad loves me. He's kind of gruff sometimes. My dad passed a few years ago, right about this time of year. But anyway, I went to my dad and I said, hey, Dad, I want a pair of Converse, leather, high-top tennis shoes. All my friends have them. They're the newest thing. They're really cool. Could I get a pair instead of the canvas kind? And my dad said, I'll tell you what, Jim. I'll lend you, didn't give me, he lent me his snow shovel. And it happened to be at that time of year, I don't remember what time of year it was, but I know this. There was a ton of snow because it snowed the night before, and our neighborhood was covered in like 2 foot of snow. And at that time, people were shoveling their driveways. And I was a big kid, even though I was young, like 10, 11 years old. I was big and strong. And my dad said, you take my snow shovel and you go around the neighborhood and you knock on doors and you tell them you're there to offer to shovel their driveway and their walkway, and ask them if they would let you do that. And then just ask them what they'd be willing to pay you. He didn't even tell me what to charge. He just said, go knock on the door and ask if they'll let you do it. And I did. I took my dad's snow shovel. He said, now, if you break it, you got to buy me another one. Like, well, how can I break it? I'm just going to shovel snow with it. Little did I know you can wear out a snow shovel pretty quick, which I did. I wore out many of them. And that's what this pink shovel represents, is something you do to add value to your community, to the world, something you do called work, a 4-letter word that is available to every single human being who has the ability to pretty much, there's so many ways you can produce value. In my case, I produce value by removing snow from people's driveway and their walkway. And I got paid deliciously for it. I mean, people were so generous because I'm this kid in the neighborhood asking them if I can shovel their snow. They wanted me to know that they appreciated me doing it. And I did a good job. And before the day was over, I had a pocket full of money. And my dad's like, now you can buy whatever you want. And I did buy those Converse canvas, high-top tennis shoes that were endorsed by Dr. J. Julius Erving, the icon of the time in basketball, Dr. Dunk. But look, the story here, the bottom line, the main event, the thing I want you to walk away with is it doesn't matter what type of account you put your money in, or your assets, or your investments. It doesn't matter if you're not funding those accounts, if you're not able to produce income and produce revenue in your life. And so that's what this shovel is about. You got to figure out, what do you do? What can you do that someone else needs? I promise you, I'm a business owner, and it's amazing to me how many people come to me and want a job. But what they don't come to me with is a solution for my problem. Like, do a little research and figure out what is needed. Like, it was super easy for me and my dad to recognize, hey, what people need that I could do, they need their snow shoveled. And then in the spring, Dad said, here's a rake. Go rake up the old leaves, or in the fall, whenever you want to do that. And then at some point, when I was a little bit older, my dad said, hey, here's my lawnmower. If you break it, he didn't even give it to me. He actually sold it to me. And I asked him, because I was big enough and I knew that all of those same people that hired me to shovel their snow would hire me to cut their grass and weed their garden and rake their leaves. And I built a business as an 11-year-old. I became an entrepreneur, not because I was smart, not even because I liked to work. I did it because I liked stuff. And I know most of you like stuff too, and at some point you're going to want to buy stuff, and you're going to need money to buy stuff. And if you want to build wealth, you need to know about types of accounts and how to be smart about investing in those types of accounts and how to allocate your assets in those types of accounts. But first, you got to be smart about how are you going to produce the money to go into those accounts in the first place, and that's what the shovel. That's why we've had this shovel in today's lesson, is because that's kind of a starting point. And I want to encourage you to, I know school is your job right now for most of you, but never forget that you can make as much money as you can possibly spend and more. But it all starts with figuring out, where can you make a difference? Where can you add value? Where can you recognize there's a problem that needs a solution and you have the solution? It doesn't matter where you work, what field you work in. I mean, I've worked in a lot of different industries, and I'm telling you, this one shovel example, it's kind of a principle to live by. And I want to end the lesson today with that principle to live by. Find some work that you can do that can make a difference, that can add value. And you will never, ever have to worry about how you're going to get the money to put into these buckets. Hope you have a great day, great week. Sorry I went long. I'll see you next time. All right, I'm going to jump on over to the live stream, and I'm going to end and finish